So discuss 3 benefits that might arise from conducting a continuous audit. Benefits, we say benefits of what? Of conducting what's called a continuous, you're being asked a continuous audit, and say as opposed to what? As opposed to traditional audits, as opposed to traditional audits. Are we together? As opposed to the traditional audits. So can we respond whether this was basically done in class? Bonnie, was this done in class? We can all agree that this was basically done. So when you talk about continuous audit, we have an auditor regularly is in the premise altogether. Let's say, for example, on a monthly, on a weekly, you have an auditor in the premise. If you look at the traditional form of audit, we only have, for example, we have audit maybe once or twice. You have an audit maybe at the end of the year, but continuous, you have an auditor regularly in the business altogether. So what is the benefit of a continuous audit as opposed to traditional way of audit? So one of the first benefits of a traditional audit, we can talk about early detection. Number one, you talk about early detection of errors and fraud together. One of the first benefits of a continuous audit is what we call early detection of errors and fraud. Are we together? Again, audit risk. If you carry out continuous audit, at the end of the year, the risk level is basically significantly reduced. Are we together? But you can talk about the third, we call it sharper accuracy. We can call it sharper. We call it sharper accuracy. We say sharper accuracy. On the sharper accuracy, you're basically saying that sharper accuracy, we can talk about by basically replacing what we call the manual process. Sharper accuracy, by basically replacing what we call the manual process with automation, we can save and reduce. By basically replacing what we call the manual process with automation, we can save and reduce. With this automation with this other. If you look at traditional form of audit altogether, there was not an automation. With this continuous audit and coupled with automation, one of the benefits that it basically does that it can save time and reduce. To say save time, and what we call and reduce, and reduce is what saves times and basically reduce. We say reduce what we call mistakes. So that is what we call that is what you basically call sharper accuracy. So they're able to reduce what we call the audit time, but at the same time, the level of mistakes are also reduced. So we can also talk about full-on transparency. So you can talk about full-on transparency. Full-on transparency. So whenever we talk about transparency, that is openness altogether. If you look at with a complete view of what we call the financial statements, financial operation, audit teams can deliver what we call transparency. So with a complete view of financial operation, with what we call a complete view of what we call of the financial operation, with a complete view of what we call the financial operation, with a complete view of the financial operation, we say teams can deliver what's called transparent. Teams can do what? Teams, we say, can deliver what's called transparency. So that is the fourth benefit. But lastly, on continuous audit, we can talk about productivity boost. We can talk about productivity. Talk about productivity boost. Lastly, we can basically talk about productivity boost. So when it comes to continuous audit, we basically understand that. So when it comes to continuous audit, we basically understand that continuous audit basically spread workload throughout the year. So you don't have to wait for the end year for you to carry out an audit. So it basically spreads out the workload throughout the year. Using what you call using chaos of end year crunch. Using what you call chaos of what you call of end year. The word is the end year crunch. Using the chaos of what you basically call the end year crunch. With this, it makes the process smoother and free time for important work. Makes what you call process, makes what you call the process, we call it easier, and we say free up time for what we call for important, free up work for important work. Free up time for what we basically call important work. So it basically does free up time for important work. So these are the benefits of what we call a continuous audit. Team, are we together? Is that understood? If that is understood, you give Mwalimu yes. You give Mwalimu yes. If that is understood, you give Mwalimu a yes. If that's basically understood, you give Mwalimu a yes. Respond with a yes if that is understood. I want us to move to the second question. I want us to move to the second question. Is that understood? On the benefits of a continuous audit? Eden, is that understood? We respond with a yes if that is understood. Eden, is that understood? We respond with a yes if that is understood. Give me a yes if that is understood. So the second part of it, you're basically being told, explain two challenges that it should be. This was Roman 1. Explain, we're told to explain what's called two challenges, and say of a continuous audit. So what are some of the challenges that basically comes with a continuous audit? Two challenges of a continuous audit. So when you have the auditors, are we together? When you have the auditors all around, what are the dangers of challenges of a continuous audit? Again, whenever you're having continuous audit, there's definitely one of the challenges called business disruption, where you have to get workers there. They'll be always disrupted in terms of auditors will come and ask you for documentation. So one of it is what's called business, and we call it disruption. We call it the business disruption. So you cannot do your work perfectly well. In between, if auditors are coming weekly or monthly in an entity, it definitely implies that work will always be disrupted. Is that understood? That is number one challenge of a continuous audit. But we can talk about which can reduces what we call the work staff morale. We can talk about reduces what they call the staff, a continuous audit. Is it cheaper to basically carry out a continuous audit? Is it cheaper to carry out? Is it cheaper? Is it cheaper? Very expensive. That's why you call it resource. I think in our class we say it is expensive. So this is just to say that it is expensive. Resource investment to basically imply that it is expensive. Continuous audits are basically expensive. Are we together? It may require what calls significant initial investment, but at the same time, maintenance of that may require a lot of maintenance cost. Then you have what's called privacy issues. When you talk about continuous audit, we have issues to call privacy issues. The beauty of this audit, it's very straightforward. The things that we've done, straightforward as they are, privacy issues. Are we together? So when you talk about privacy issue, continuous audit can basically affect continuous access to real data, with continuous We can talk about with continuous access to what we call to real data, If you can basically access real data on a continuous basis, what is that? Protecting sensitive information, protecting what we call sensitive information. Are we together? Protecting sensitive information, protecting what you basically call sensitive info may be required. Protecting what we call sensitive information may be required. Protecting what you basically call sensitive information may basically be required. That means that you establish what you call a robust data protection framework. So that will basically require that you establish what you call a robust data protection framework together. So these are limitations of a continuous audit. But there's also a very good point that we talked about. You see, the management may leave the work to the auditors altogether. They may think that it is the work of the auditor. The management can rely on auditors to carry out their work. Management may rely on what you call on auditors to help in the work, to help in what you call in their work. If that is understood, you give me yes. So that is question 1, A Roman 1 and 2. If that is understood, you give Malima yes. Give me yes if that is understood. Perfect, thank you. So I want us to move on question 1B. We'll look at question 1B. And as I repeat it, this paper is straightforward. As we work on this paper, we will see that this paper is basically straightforward. So let's look at the second question. And this second question is basically 10 marks. So you're being told that your firm, Zawadi and Associate, has been the auditor of Magari Limited. Your firm, Zawadi Limited, has been the auditor of Magari Limited, which has been dealing with motor vehicle spare parts for the past 10 years, been dealing with motor vehicle spare parts for the past 10 years. Due to the long association, a partner in your audit firm has requested to sit in Magari Limited board meeting to provide advisory service. To sit in Magari board meeting to provide what called advisory service. The company is advisory service. The company is one of your key clients for the past 5 years. Approximately 30% of the firm gross revenue has been obtained from Magari. Approximately 30% of the firm's revenue has been obtained from Magari Limited, from assurance and taxation services. Last year, Magari Limited poached 2 audit managers. From your firm to support the internal audit and finance department. To basically support internal audit and finance department. Then you're being told that in September 2025, Magari Limited issued shares during the initial public offer, that is IPO. Zawadi and Associate was involved in promoting the shares of the company. Zawadi Limited was basically involved in promoting the shares of the company. Before I begin to read the question that follows, what are some of the queer things that you see in this relationship? What is some of the things that you basically see? What is some of the queer things that you basically see that may basically affect that relationship? What is some of the queer things that you see in this relationship? I want us to discuss, be very open. Yes, that is, what is some of the queer things that you see in this relationship? Number one, I see aspect of familiarity. Aspect of familiarity. Let's say, for example, you've had a long-standing relationship with a person, let's say for 11, 12 years. Do you think that person you can easily compromise when it comes to such a person? I see something long-standing relationship, which basically brings the aspect of familiarities. Are we together? Is that true? Do you see a long-standing relationship in that? I want us to engage. It's not just see a long-standing relationship in that. I want us to engage. It's not just about answers. It's about working together. Team, don't be quiet together. This class. So the fact that there has been a 10 years standing relationship that brings the aspect of familiarity. Imagine having had a relationship with somebody for 10 years. That person, no professional work, such a person can easily compromise due to the aspect of familiarity. But I'm also seeing the aspect of what we call advocacy. Do you see advocacy? Do you see advocacy? Where the audit firm is basically promoting the shares of Magari Limited. There is the aspect of advocacy. Advocacy. What do you see again? What do you see again? The self-interest, are we together? The self-review and self-interest. Look up, in audit, we're saying that a firm should not basically depend, are we together, on in terms of audit fee. If more than 15% of your revenue comes from a single firm, in this case, 30% of the of revenue that is for Zawadi Limited comes from what? Magari. So if a firm heavily depends on, if an audit firm heavily depends on a firm, it creates what we call a self-interest threat. Do you think if that firm was on the wrong, would you depict it an audit? Would you share those facts to the shareholders? If this firm was basically doing something wrong, you know that when you share, you're going to lose your job. Definitely. There's review also in that. So what is the question that they are basically asking? What is this question that they're basically asking? So they're asking, evaluate 5 ethical threats from the engagement between Zawadi and Associate Limited and Magari Limited. Evaluate what we call 5 ethical threats to engagement that is between Zawadi, ethical threats to engagement. So we call it ethical threats to engagement. So we say between Zawadi, Zawadi, Magadi Limited, and Magadi Limited. So what we call ethical threats between the engagement between Zawadi and Zawadi Associate and Magadi Limited. So one of the threats, we call it familiarity threat. So we have it as familiarity threat. So one of the first threats is to call it familiarity threat. So we have familiarity threat as a result of 10 years. We have it as a sum. Firm has been auditing. We call it firm has been auditing. Magadi, for what we call for the past 10 years. The firm has basically been auditing Magadi for the past 10 years. This basically impairs their job. This will impair. This impairs what we call their judgment. This basically impairs what we call their judgment. their judgment due to long association with the client, due to what we call due to long association, and you say with the client, due to the long association, and you say with the client. Is that point clear? If the point is clear, you give Molimo yes. So the second threat, we have it as what we call it self-interest threat. The second, we call it self-interest threat. So the second, we basically call it self-interest threat. And you're saying that farm draws significant portion. Farm draws what we call significant of what we call of its income. And significant, this is 30%. You can state 30%, significant portion of his income from Magari. And I can notice this is 30%. So if it draws a significant portion of its income from Magari Limited, what is the danger of that? If it draws a significant portion, we basically understand that therefore, we say that therefore, as a result of what's called the financial dependence, as a result of financial dependence, the farm may end up financial dependent. The farm may end up doing anything. Let's say not to do what? To lose the farm. Which this case is Magari. So their interest will come first, and that is money. Is that understood? If that is understood, we respond with yes. Respond with yes if that is understood. So the next is what we basically call self-review threat. We have a self, and we call it review threat. So self-review threat. Or the self-review threat, we're basically saying that due to the work, due to the fact, and say that due to the fact that Zawadi, and say an associate, due to the fact that Zawadi and associate offers what we call taxation, services, and you say in addition to what we call assurance, services, in addition to assurance services. So they say this would mean because aspects of taxation, this would basically mean, and to say that this would mean that they may be auditing, that they may be auditing what's called their own work. Because part of taxation, again, also we need to provide assurance on issues to do with tax. So as a result of that, because of the ones who are offering assurance, they could be auditing their own work. Give me yes if you're together. Respond with the yes if you're together. Then you have what's called advocacy threat. We have what's called advocacy threat. So lastly, advocacy threat. And whenever we talk about advocacy threat, it basically emanates from the fact that the firm is basically promoting the shares of Magari, which can publicly, the firm publicly involved in promoting what's called the shares of Magari Limited. The firm basically is publicly involved in promoting together. the shares of Magari. So if they do that, that basically impair. This basically impairs. We basically understand that that would basically impair independence. Impairs what's called independence. This will basically impair what's called their independence in appearance, independence in appearance as an auditor. Together, team. So we can have one last one. So we needed threads. How many threads? We can have the last thread. We can have the last thread. So on that last thread, we say the management thread due to the fact that management thread, and say due to the fact, so we have what's called the management thread due to the fact that from time to time, what happens from time to time? We are talking about the management thread due to the fact that from time to time, what happens from time to time? We are talking about the management thread due to the fact that from time to time, partners in Zawadi and associate, due to the fact that from time to time, partners in what we call in Zawadi, and say an associate, partners in Zawadi and associate, due to the fact that partners in Zawadi and associate are basically called upon. What are they called upon to do? Called upon to do what? To sit in a board meeting. To sit in what's called in a board meeting, and you say ends, and you say acting as. Hence, these guys are basically acting as what? Acting as management of the company. Acting as management of what they call of the company. Hence, these guys basically act as the management of the company. That was question 1. 10 marks, 6 marks for the first one. That is 1 Roman A, 4 marks for A Roman 2. Then finally B is 10 marks. Is that question doable? Is that question doable? And do we have that in our notes? If we have that in our notes, we respond with a yes. Perfect. So when it comes to this audit and assurance, that is, nobody should, this one you should score 90s, 80s, 90, and 100. Yes, because if you look at what we've done, it should be, so this question 2A, it's something on emerging issues altogether. These are basically on emerging issues altogether. So I have a question number 2. Question 2 is part of emerging issues that I'm supposed to discuss on a Sunday together. But however, we are going to discuss it. Question 2, Roman A, is part of emerging issues that I'm supposed to discuss on what we call on a Sunday together. Is part of emerging issues that I'm supposed to discuss on what we call on a Sunday together. Part of emerging issues that I'm supposed to discuss on a Sunday. But I will explain them. We say explain the following terminology. Explain, number 2, explain. We call it explain what's called the following terminology. The following terminologies. Explain what's called the following terminologies. Explain what's called the following terminology as used in contemporary, as used in what's called in contemporary, as used in what's called contemporary audit. Give me a yes if you're there. So explain the following terms is basically used in contemporary audits. So I want us to look at the first term. We call it social. Social engineering. Heard of that term, Blessy? Jackie, have you heard of that term? It's part of emerging issues, those terminology. Have you heard of that term, Eden? So we go to it. What is social engineering? When we talk about social engineering, social engineering. Social engineering. This is crafty. It comes from the aspect of crafty. So we say that when we talk about social engineering, we say use of what we call deception. We say use of what we call deception. Deception. You're basically using deception to manipulate individuals. To do what? To manipulate. To manipulate. We say to manipulate. To manipulate individual. And why are you manipulating individual? To divulge. The word is to divulge what we call the confidential. To basically divulge confidential information. To divulge what's called confidential information. For what? For what purpose? Why would you want that? To divulge what we call confidential information for fraudulent purpose. For fraudulent, call it fraudulent purpose. For fraudulent purpose. For basically what's called fraudulent purpose. If you've done ICT, you remember looking out for phishing attacks online. We can talk about phishing attacks. Phishing attacks online. Looking for phishing attacks online. Together on social engineering. Give me yes if that is perfectly understood. But respond with a yes if we are there. Is that understood? Give me yes so that we work together. So then we have what we call embedded audit facility. Embedded, we have it as embedded audit facilities. So we call it embedded audit facilities. What are embedded audit facilities? It's good to see you, Wiko Dangote. You have been lost as a representative. I hope you are now fully in for blocks to that end. So embedded security, embedded audit facilities. What are these? What is embedded audit facility? So whenever we touch on embedded facility, a technique refers to what's called a technique. Refers to what's basically called a technique where programs, we call it where programs is a technique, so basically where programs and what's called and additional data, and we call it additional data. And additional data is a technique or a process where additional data are provided by auditor, provided by an auditor, provided basically by an auditor, say are incorporated. We say are incorporated, basically are incorporated. And the word is in what's called in a computerized, are basically incorporated in a computerized system. That is embedded audit facility, are incorporated in a computerized service together. So we say enable continuous review and accounting system. So this one enables, when you have this, enables what's called a continuous reviews. Continuous review. When that data or programs are basically put into a computer system, it facilitates what's called a continuous review. Is that understood? Give Mwalimu a yes if that is understood. That is embedded audit facility. Then we have what we call the last one. We call it integrated. The last definition, we basically call it integrated. We call it the 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 integrated test facilities. Test that we say that enables what's called the auditor to do what? To test. It enables the auditor basically to test. And we are testing what we call logic, and you say and control. The word is logic and control during normal, and control during what's called normal operation, and control during normal operation. So it's basically a technique. This is tech. When I say it's basically technique, call it technique, that basically enables the auditor to basically test logic and control. It enables the auditor to basically test logic and control during normal operation. Provide me the yes if we are together on that question. That is question 2. Question 2, Roman A. Perfect. Let's proceed to question that is December 2025. I want us to proceed to question 2, Roman B. Turn to that paper that has been shared. Question 2, Roman B. Question 2, Roman B. I want us to touch on that question 2, Roman B. And I believe that question is something that we've done, and we did it very recently. If you look at that particular question, so let's turn to that question. The examiner tells us that when an auditor uses what we call audit sampling, when an auditor basically uses what we call audit sampling, and we understand what sampling is and why we carry out sampling, the objective is to provide what we call assurance. The basis to provide reasonable, the objective is to provide a reasonable basis to draw conclusions about population from which sample is selected. So when you talk about sampling, you're saying that because a sample could be huge altogether, and you may never carry out an audit of a huge sample, of a huge population. Sometimes you find the population is so huge. So you basically do what you call sampling altogether. You do what you call sampling because of time. Are we together? Because you may never have time to carry out audit for the whole population altogether. But when it comes to sampling, we're also very keen that annually take altogether. If the risk level is very high, are you going to take a smaller sample or a larger sample? If the risk level is basically high, are you going to take a smaller sample or a larger sample? If the risk level, if you notice that the risk level is very basically high, definitely you're going to take. If controls in organizations are weak, let's say, for example, you are able to evaluate and identify that in an entity, controls are weak, or in a population, controls are weak. Are you going to take a smaller sample or a larger sample? Are you going to take a smaller sample or a larger sample? Perfect. So we get to the first question, that is B Roman 1. B Roman 1. Distinguish between statistical sampling. So it talks about distinguish. We talk about distinguish, and you say between. The word is between statistical sampling, statistical sampling, and non-statistical sampling, and non-statistical sampling. Distinguish between what it calls statistical sampling and non-statistical sampling. My first question, have we done that in and non-statistical sampling? My first question, have we done that in class? Have we done that in class? Statistical is basically on mathematical approach, where you basically use what we call probability together. We basically talked about statistical mathematical approach, where you incorporate what we call probability. So we can just say involves what we call random selection. So we can solve random selection. We can talk about random selection. This one basically involves random selection. We call it random selection of a sample, of what we call of a sample, random selection of a sample and use what you call use probability. Use what you call probability. Use the word probability theory to do what? To evaluate the sample. To evaluate the sample. But you can just say mathematical approach that uses what you call probability to evaluate the sample. Is that noted? You can simply say mathematical approach that basically use what you call probability to evaluate what's basically called the statistical. That is statistical. So then the second, we call it non-statistical. Non-statistical. We call it non-statistical sampling. So what would be non-statistical sampling? Someone will tell me the opposite of statistical. So it does not use probability, but this one uses the auditor's judgment. This basically uses the auditor's judgment. So we talk about where auditor does not use statistical, where we say the auditor does not, the word is does not use what we call statistical. So basically say, in this case, the auditor does not use what we call statistical, but you say statistical method, but now the aspect of that, but draws what you call opinion, and you say about the population. Draws a judgment, involves probability, but he uses what you call judgment. He draws conclusion out of his own judgment. Together, team. Give me a yes if we are together. On that question, is that sorted? So that's B. So B, that should be about 4 marks. Is that at home? You give Mwalimu a yes. Mwalimu also need encouragement. Yes. Vanessa, is it true that Mwalimu also needs encouragement? Yes, Mwalimu also needs encouragement, by just responding. So then we have the next part of it. Again, this is also something, describe 4 methods of random sample selection. Describe, there were a lot. Describe, what they call 4 methods of what they call of random selection. If you've been very keen, random sample selection. So describe what's called 4 methods of random sample selection. So if you've been very keen, was this done in class? This was definitely done in class. So we can talk about simple random sampling. We can talk about simple. One is simple random sampling. Simple random sampling. So when it comes to simple, we say selection of sample. Selection, we talk about simple selection of what is basically called sample. Sample, the word involves. So when you're basically selecting the sample, it basically involves, we say involves random, and they call it numbers, random numbers, tables. We call it the random numbers tables, or what called the random, or what you basically call the random numbers generator. Random numbers generator. Ensure that all items in the population have equal chance. So this one ensures all items in what's called in the populations have what we call have equal chance. So they have an equal chance to be selected. So whenever we talk about a simple random sampling, you basically the selection of sample basically involves what we call random numbers. And the essence of the random numbers is basically to ensure that all items in the population have an equal chance to be selected. Give me a yes. Have an equal chance to be basically selected. So that is the first type. Give me a yes on that. Give me a yes on that. If we are together, you give me a yes. So the second, we can talk about systematic selection or sampling. Systematic, we can talk about systematic selection, statistical sampling. Systematic selection, statistical. The word systematic, the word systemic. Selecting items, we say selecting. So this is basically selecting what we call items. You're basically doing what? Selecting items, selecting items, using what we call consistent, selecting what we call items using what we call consistent, intervals, and say between, intervals between, selecting items using what we call consistent intervals between selection, between what we call selection, between selections. So we have the word consistent interval between selection. Are we together? The first interval having a random start. The first interval having what's called having a random start. So this is basically selecting items using what we call consistent intervals between selection. So that is what we call systematic selection or sampling. Give me a yes if you're together on that. If we are together, you give me a yes. So then we can talk about cluster sampling. We can talk about what's called cluster sampling. So what is a cluster? When you say a cluster, what does a cluster mean? When it comes to talking about cluster, what does a cluster mean? So you're dividing population into groups, and those groups are what we call clusters. So population, so the word is population. We say population is what? Is divided, and the essence is divided into what's called into groups. Populations, we say, are basically divided into groups, and those groups are basically known as clusters. Those groups are basically known as clusters. So basically have population being divided into groups, and those groups are called clusters. And you say they're usually based when you talk about cluster, we say they're usually based when it comes to cluster. They're usually based on geographical, or what's called or existing. The word is existing classification. So how do you select them? On geographical or existing classification. So classification is made on geographical or existing classification, such as value of risk, such as so an auditor basically randomly selects a cluster rather than what? Rather than a single item. So then we have what we call stratified. We can talk about stratified sampling. Stratified sampling. When it comes to divide population into smaller, so we say divide, and say population into smaller, so we say divide, and say population into what's called into smaller, dividing population into smaller. So in this case, you divide population into smaller, non-overlapping groups. So call it non-overlapping groups, non-overlapping group. So you're dividing population into smaller, non-overlapping groups, and that is what we call strata. Strata, non-overlapping groups that we call the strata. And say based on shared characteristics. This is based on what's called on shared. So the word is shared characteristics. Based on what's called shared characteristics. So those strata are non-overlapping groups that are known based on shared characteristics, such as what we call value or risk, such as value or what we call or risk, such as value or the risk level. So that is how you basically, based on shared characteristics, based on value or risk altogether. So sample is then drawn from stratum. Sample is basically drawn from stratum, based on shared characteristics or value or risk. Then you say that the technique is useful. Technique, we say the technique is basically useful in what's called in heterogeneous. So this technique or certified is basically useful in heterogeneous population to do what? To allow auditor, we say to allow the auditor to do what? To focus. Not focus college, to focus, or you can say focus college, to focus higher value on higher value or higher value item. To basically focus on higher value item. If you check our notes, how many types of methods of random sampling? In the notes we have how many do we have? In the notes we have about 10. Can you confirm that we have about 10 in the notes? In the notes we have about 10. Is it true, Tim? If you look at the notes, we have about 10 in those notes. I want us, the bigger work has been done. Whatever we are doing, we're just enjoying the bigger work that we've done. Yes. The bigger work that we've done. Yes. The bigger work was done in class. Yes. We are simply just enjoying what we're doing. Is that true, Jacqueline? That the bigger work was basically done in class. Most of the work was done in class. So now it's time to just enjoy the fruit of our labor. So when we get to Roman C, So we're going to discuss auditor's responsibility. In detecting errors, fraud, and irregularities in audit engagement. So we say, describe auditors. The C describes what we call auditors' responsibilities. Auditor's responsibility in what we call in detecting. We call it in detecting errors, fraud, and we call it irregularities. In detecting what we basically call errors, fraud, and illegality in an audit engagement. In an audit, irregularities. In detecting what we basically call errors, fraud, and illegality in an audit engagement. Was that topic done? Errors, fraud, and irregularities. If it was done, you give me yes. Perfect. What is the auditor's responsibility in detecting errors, fraud, and irregularities? What is the auditor's responsibility? And say in detecting errors, fraud, and irregularities. Errors, fraud, and what you call irregularity. Number one, what is the primary objective of an auditor? So how would you classify detection of errors and fraud in relation to an auditor? Is it a primary objective of an auditor? Is it a primary objective of an audit? No, it's a secondary objective altogether. The primary is basically to give an audit opinion. So the examiner asks us, describe what's called auditor's responsibility. Auditor's responsibility. Describe what's called auditor's responsibility. And say in detecting errors, fraud, and irregularities. What is this responsibility? So is the main responsibility of management basically to detect errors and fraud and not the audit altogether? So is the main responsibility of management basically to detect errors and fraud and not the audit altogether? The auditor can never be held responsible for prevention of fraud and error. At the back of your mind, because this is secondary, an auditor, we say that cannot be held responsible. This is the work of management, cannot be held responsible for the objective. So it can never be held responsible altogether. So one of the things that it needs to do, responsibility altogether, one of it we call it inquiries. We can talk about inquiries. I want to expound on the inquiries. So when you talk about inquiry, auditor should make inquiry to say that auditor should basically make what I call inquiries. Auditor should basically make inquiries. Auditor should basically make inquiries from management and to say others. Auditor should basically make inquiries from management and others within the entity. Within the entity, should make inquiry from management and others within the entity, whether they have knowledge, whether they have knowledge, where they have the knowledge of any actual, of what I call of any actual, or what's called, or the suspected, we call it suspected, or alleged fraud in an entity, or alleged fraud on evaluation. So I just want us to be easy. Now it should be easy. Till the time that you're doing exam, we should have easy time. Nobody should be under duress. Evaluation. So when it comes to evaluation, auditor should basically evaluate whether the unusual, we call it whether the unusual, whether what's called the unusual or unexpected, or what's called unexpected, unusual or unexpected, relationship, and you say that relationship that what's called that have been, auditor should basically evaluate whether unusual or unexpected relationship have been identified. We say have been identified in performing. So the word is in performing analytical, we call it analytical procedures. We say may indicate what's called, indicate risk, and you say of material misstatement, risk of what we call material misstatement, risk of what we call the material mistake, risk of material misstatement. So the second evaluation, auditor should basically evaluate whether unusual or unexpected relationships that have been identified in auditor's responsibility in relation to errors, fraud, and irregularities. whether unusual relationships that have been identified when you're performing ARPs together may indicate what you call risk of material misstatement. So the second is what you call evaluation. But it's not that auditors cannot be held responsible for fraud and errors. That is the responsibility of management altogether. Elizabeth, give me a yes together. So the second is evaluation. Is that understood? If that is understood, we respond to this. If that is understood, then we have written representation. So this is an auditor's written representation. So we have what we call management written representation. This is where there is no, on issues that are material. On issues, we say that on issues that are basically material, meaning the omission or mistake. On issues, we say that on issues that are basically material, meaning the omission or misstatement, basically affect the financial statement. If there's no sufficient evidence, then the auditor needs to have what we call a written representation. Are we together? Examples of a written representation. Examples are minutes of the board. So we're saying on written representation, as the third responsibility of an auditor, we are saying that auditor should basically obtain a written representation from the management concerning the following. One of the things, number one is management, and you call it acknowledgement. Acknowledgement of what they call of their responsibility. A written representation of their responsibility to ICS. So what is that responsibility to ICS? The management should be responsible for designing an efficient, they should be responsible for designing, we know that designing and maintaining what you call a system that basically detect and prevent fraud. It is not the role of an auditor to come up with this. In relation to written representation, we think that auditor should basically obtain this representation from management, that they have a responsibility to the ICS, that is designing and maintaining a system that can best ICS. The responsibility of an auditor in relation to ICS is that they can look at the system, and once they see there's something wrong with the system, they're supposed to do what? They're supposed to report it to management through what you call a management letter. If they find there's deficiency in the system, the role of an auditor is basically to report this to the management through what you call a management letter. So you can report those deficiencies, but at the same time provide what you call a recommendation on how better to make the system better. But when it comes to the ICS, that is making sure that you design a system and maintain a system that is proper, it is the work of the management. So as part of the responsibility, an auditor should basically obtain what we call a written representation that management basically acknowledge that it is their role to have a strong system that is able to detect and prevent what we call fraud and errors. Are we together? Then say disclosure, management disclosure. We can talk about management disclosure. Management disclosure to the auditor. That management disclosure to the auditor. The results of assessment, we say results of what we call of assessment, that the results of what we call assessment of what we call of the risk, assessment of the risk, of what we call of material misstatement, of the material misstatement, of the material misstatement as a result of fraud, as a result of. Lastly, in relation to fraud, professional, we call it professional skepticism. What did you say is professional skepticism? I taught on the professional skepticism. What is a professional skepticism? Being alert in relation to fraud. When you talk about professional skepticism as a responsibility of an auditor towards fraud and errors, what is professional skepticism? So being alert together An auditor should basically be alert to any fraud, errors, and irregularities together. So this is an attitude of expression to the financial statement altogether, where an auditor we say should do what? Should basically be alert and sound to any fraud, errors, and irregularity. Are we together? Are we together? Respond with a yes. Are we together? Are we together? Perfect. Are we together? Evaluate. They can also evaluate appropriateness of accounting policies. We can talk about evaluating what we call appropriateness of accounting policy. Appropriateness, because this appropriateness of what we call of accounting policies. Because this is definitely what is going to lead to fraud. So they can also evaluate the appropriateness altogether. But again, also design what's called appropriate audit procedures altogether. Are we together? Design appropriate audit procedure. Again, we can talk about designing what's called appropriate audit procedures. If you look at our notes, did you touch on these things? If you look at our notes, can you say that Mwalimu, yes, we did touch on this? Did you touch on that? Give me yes if you touched on that. If you're very keen on what we're doing, we did touch on that. So do we need a break or we don't need a break? Do we need a break or we don't need a break? So I've done two questions, question 1 and 2. Yes, you can have the break. Then you come back 10 minutes, then you come back. So I've done question 1 and 2. That is December 2025. Yes. Then you come back 10 minutes, then you come back. So I've done question 1 and 2. That is December 2025. Yes. So you're proceeding to question 3. That is on December. Question 3. Question 3. That is on December. So we can be through with this paper on question 3. Question 3, 2020. So we have it as question 3. So question 3. So on question 3, so are you on it? If you're on it, respond to this. So they told that with reference to international standards of auditing, that is the ISA 230. So what does ISA 230 talks about? That is audit documentation. ISA 230 is audit documentation. We have it as audit documentation. ISA 230. So they told describe 5 roles of audit documentation. Describe 5 roles of what we call of audit documentation. Let us say in supporting, auditor's opinion, in supporting auditor's opinion, in supporting auditors' opinion and accountability. What is the role of audit documentation? That is ISA 230 in supporting auditors' opinion and documentation. Did you talk about audit documentation? We talked about working papers, and we talked about document. So what is the role of audit documentation? Role of audit documentation in supporting auditors' opinion and accountability. So one of the first role is evidence of work performed on the basis of conclusion. Number one is evidence of work. Evidence, it acts as evidence. This documentation, audit documentation, evidence of work done, evidence of what they call of work done, evidence of work done, and the basis of conclusion. And the basis of conclusion. Evidence of what's called the work done and the basis of conclusion. So you can tell how an auditor basically arrived at the opinion. If it was a qualified opinion, how did he arrive at that qualified? Unqualified opinion, evidence to support the work. If you're talking about X and Y, there's evidence basically to support on that. Get that in. That is the first one. Give me a yes if you're together. The second, support quality control and external. So it does support what's called quality control. It does support what's called quality control and what's called an external inspection. It does support what's called quality control and what's called inspection. Then you have provide accountability. This documentation basically provide accountability. Accountability. So they definitely provide what's called accountability and legal defense if challenged. And legal, those documentation will be legal defense if challenged. Legal defense, if you say if challenged. If it's challenged, they act as legal defense. If an auditor basically is challenged. Legal defense, and you say if challenged. Legal defense, and you say if challenged. Then you can also talk about ensure continuity. It does ensures what's called continuity. It does ensure what's called continuity when audit staff change. When audit staff change. When audit staff change. Staff change. Audit staff. We can basically use them in training, what we basically call audit staff. So we can also talk about facilitate. We talked about support quality control and external. So we can also talk about facilitate supervision and review of audit work. Facilitate supervision. And the word is review of what we call of audit work. It does facilitate supervision and review of what's called the audit work. It does facilitate supervision and review. Are we together? So again, it acts as compliance. We can talk about compliance of audit requirement. We can talk about compliance to what they call to audit requirements. Documentation is part of compliance to audit requirements. Are we together? Of audit requirements and regulation framework. And regulation, you must have documentation and regulation framework. So we have compliance to what we call the audit requirements and what we call the regulation requirements. Give me a yes if you're together. So that is number 3. Describe the roles of audit documentation in supporting auditor's opinion. Do you have something like that? Importance of documentation. Do you have importance of documentation, audit documentation? Do you have it in the notes? Importance of audit documentation? Yes, we do. So the next question, we just talked about it, implication of inadequate. So B talks about, that is Roman 2. 5, what's called the quality, during what's called quality, during quality reviews, during quality reviews of what they call of regulatory inspections. So that's the next question. We may not be able to have time. In 5 implications of what they call of inadequate audit documentation during quality review. Are we together? So what is the implication, for example, at the back of your mind? What would be an implication of what we call inadequate documentation, inadequate working papers during or quality review of regulatory inspection? What is the implication? So if you have inadequate papers or documentation, one of the implications is that what we call inability to justify opinion. Are we together? You'll not be able to justify an audit opinion. Are we together, Blessy? Are we together, Elizabeth? Are we together, Jacqueline? So one of the implications of what we call inadequate audit documentation, you're not able to justify what's called audit opinion. And once you're not able to basically justify an audit opinion, it eventually leads to what we call, audit failure. So if you cannot justify audit opinion, it does lead to what we call audit failures together. So that is one of the implications of inadequate documentation. It will eventually, on a Sunday, just to clarify, environmental audits, social audits, public sector audit committee, what is it? Internal audit control, just to touch on them so that you get to understand them altogether. So we close with that. God bless you. Thank you, Awiko. Unless somebody has something, I beg that you close it there. I hope you're now beginning to be ready for exam. Let's be ready for exam. Let us be ready for exam. Let us begin to be ready for exam. So we can wrap it Is that okay? So along the way, I will be talking about basics and how we can basically go about those questions, but allow us to pick a question. So there's a simple question on partnership, then we pick a much complex question so that would make it even much easier. So look at August 2023. Check something on August 2023. There should be some August 2023. If there is just a minute, we check on something. September 20, the simplest question. Just a minute. So August 2023. August 2023, we pick question 4C. August 23, question 43. August 23, question 4C. Together, question 4C. So my name is Cpa Odongo. For those who are new in this class, my name is Cpa Odongo. So we can pick on that particular question. We respond with a yes if you're there. August 2023. So today I want just to break down on partnership. We break on partnership, and if we get time, we will also be able to break on at least, in 2 hours. If we can do this, it's much simpler. So we can break on the partnership. Respond with the yes if you're there. Respond with the yes if you're there. Are we there on August 23? Question 4. Perfect. So look up. So being told that we're being told that Mambo, motor, and motor car are in partnership. So these 3 gentlemen are in partnership, sharing profit and losses in the ratio of 2:1:1. So we have 3 gentlemen. We have Mambo. We have the next, we call the motor, Mambo motor, and then we have motor car. Are we there? And motor car. So basically being told that these 3 gentlemen are sharing profit and loss in the ratio of 2:1:1. So we have a total ratio of 4. Are we together? Are we seeing a total ratio of 4? Juliet, are we with us? Are you with us? A total ratio of 4. So this is what Mambo gets. Mambo gets 2/4, which is equivalent to a half. So Mambo gets a half. Motor gets a quarter, is supposed to be shared for a quarter of the profit. Then motor car also shares what you have as a quarter. Is that understood? If that is understood, we give it a yes. If that is understood, we give it a yes. So then if that is understood, we give it a yes. So then we turn the page. So we've been told the statement of profit and loss for the year ended. The statement of profit and loss for the year, we are given GP to be 4.2. We are being given the sale of delivery vans proceed as 1.4. So on those incomes, what should we know on the part of the incomes? If you have incomes. In taxation, if you're given an income statement and you're given an income statement on the income, you need to understand the concept of taxable income. And then you also need to understand what's called non-taxable income. So what is taxable income? So in taxation, when you talk about taxable income, these are basically income. Give me a yes if you're together. I hope we are together. Incomes that are not subject to taxation. So if we had an income statement, team, if we had an income statement, are we together? And we are getting what's called the adjustable taxable income. For the taxable income, are we going to adjust them if you're getting the adjustable taxable income? Are we going to adjust the taxable income? Are we going to adjust the taxable income? So we're not going to adjust the taxable income. But for the non-taxable income, if they are in the income statement, what do we do to them? For the non-taxable income, we adjust them by deducting them. Are we together? For the non-taxable income, these ones are not adjusted when you're using the net profit income. These ones are not adjusted when you're using the net profit method. Net profit method. We say net profit method. We say we adjust by doing what? By deducting. Are we together? By deducting. What is the logic behind it? What is the logic behind it? So basically, the logic behind it, when you say non-taxable, when you have a non-taxable income, what does it do to the profit? When you have an untaxable income in the profit, the logic is that it overstates the profit. It does overstate what you call the profit. Give me yes, it does overstate what you call the profit. It does what? It does overstate the profit. So the correction is to do what? Is to deduct the figure from it. So the examiner is basically testing whether you understand the concept. We have the allowable expenses, and then we have what's called the non-allowable expenses. So we have what's called the allowable expenses, and then we have what's called the non-allowable expenses. What are allowable expenses? When you say allowable expenses, what is allowable expenses? So expenses, we say can be deducted, we say can be deducted. And the word is against what's called the taxable income. We can deduct them against the taxable income. So the other name for non-allowable expenses, we can also call them disallowable expenses. So when you talk about disallowable expenses, we say that these expenses cannot be deducted. So the word is cannot be deducted. Deducted, we say against. They cannot be deducted against what we call a taxable. Against what we call a taxable income. Are we together? So look at two things that I'm teaching on this. Two things. Number one, if I have allowable expenses in the income statement, do you think I should adjust them? If I have allowable expenses in the income statement, should we adjust the allowable expenses in the income statement? If you're using the net profit method, should we adjust them in the income statement? If you're determining the taxable income, if you have allowable expenses, but not human, should we adjust the allowable expenses? Should we adjust the allowable expenses? If they're in the income statement. Non-allowable expenses, if they're included in the income statement, if they are included in the income statement, if they are basically included in the income statement, we adjust them for the non-allowable expenses. We will definitely adjust them. We will definitely adjust them to do what? To get what we call, to do what? We will adjust them. And how are we going to adjust them if they're included? How do we adjust them, the non-allowable expenses? We adjust them by adding them back. We say adding them back. So why do we add them back? Because when you have an non-allowable expenses and you've included them in the P&L, they do what? They understate the profit. So they basically understate what we call the profit. They basically understate what we call the profit. And the correction is that if they understate the profit, then you need to add them back together. So I want us to work on those expenses. So the first expense that we have for this particular question, we are being told that the first expense is what we call advertisement. Is advertisement expense allowable or non-allowable expense? Advertisement expense. Is advertisement expense allowable expense or a non-allowable expense? Advertisement expense, that should be allowable. However, if you have an additional information, look up team, if you have an additional information, there is advertisement expense that is non-allowable. Are we together? And we call them capital. We call it capital advertisement expense. Advertisement expense. For example, erection of a billboard erection of what we call a billboard, erection of a billboard, and a signpost of a signpost. So these ones should be non-allowable. Is that understood? So, but if you have advertisement without any additional information, then we outwardly treat it as allowable. Then the next is basically deposition. Based on tax law, how do we treat deposition? Is outwardly called non-allowable expense. In place of deposition, what do we use in taxation? In place of deposition, we have for taxation, we have in place of deposition, we have the investment allowance. In taxation, we don't have an expense called deposition. In accounting and IR, we have an expense called deposition. However, in taxation, we have an expense called investment allowance, to what we call capital allowance, in place of deposition. So the next expense is what we call rent and rates. How do we treat the rent rates? Rent and rates. How do we treat the rent and rates? So rent and rates. How do we treat the rents and rates? That should be allowable expense. Then we have general expenses. General expenses. How do we treat the general expenses? General expenses. How do we treat the general expenses? That should be allowable expense, unless otherwise there's additional information to say something contrary. Then you have the next, we call it value-added tax. Value-added tax. Value-added tax. All forms of taxes, those should be non-allowable expense. All forms of taxes, that should be non-allowable expense. The essence is to look at whether it relates to a revenue item. If it relates to revenue items. If the bad debt basically relates to a revenue item, then it should be allowable expense. However, if you have a bad debt that relates to a fixed asset altogether, that relates to a fixed asset, then that should be non-allowable. Together, that should be non-allowable. If you have a bad debt that relates to a fixed asset, because that's not a revenue item, and it's a capital item, then that should be non-allowable expense. Understood? Give me a yes if that is understood. Respond with a yes if that is understood. Perfect. Respond with a yes if that is understood. Great. So then we proceed to the next. We're being told that as it stands, when you have a budget without additional information, we call it allowable expense. If you have budget without additional information, then we have it as allowable expense. So we can check the additional information if you have. So then we proceed to the next. We have what's called purchase of furniture. How do you treat purchase of furniture? When you say purchase of furniture, how do you treat purchase of furniture? That's a capital expenditure. We treat it as a non-allowable expense. We treat it as a non-allowable expense. So then we have the next, what's called salaries and wages. Salaries and wages. How do you treat salaries and wages? Salaries and wages. Remember, this is a partnership. Remember, this is a partnership. So under partnership team, under partnership, salaries to staff is allowable. However, salaries to partners, do you think salaries to partners, should it be allowable or non-allowable? Remember, this is partnership. Salaries to partners. Suppose you told salaries to partners is non-allowable. However, salaries to staff, we are going to treat them as allowable expense. We are going to treat them as allowable expense. Then we have the next information. So we are told that legal fees. Somebody says non-allowable. No, check. So in an exam, look at two things altogether. If you have legal fee, you're told legal fee, and you say without additional information, information, If you have legal fees without additional information, that is outrightly allowable legal fee. Tuko pamoja. So if you have an exam and you're given a legal fee in the income statement and there's not an additional information, then we are going to treat it as allowable expense. Are we together? So if you're told salaries to partners, then you know there's a portion for the partners. However, if you're not told salaries to partners, then we treat it as salaries to staff. We treat it as salaries to staff. Martin, are you answered? Then you treat it as salaries to staff. Martin, give me a yes. Martin, respond with a yes. Perfect. And I was also saying something very fundamental, that if we have this legal fee and we do not have additional information, then we treat that additional legal fee as allowable legal fee. Respond with a yes. We will treat it as allowable legal fee. Respond with a yes. However, how do we treat the interest on partners' capital? How do we treat the interest on partners' capital? How do we treat interest on partners' capital in relation to partnership? Interest on partners' capital. Interest on partners' capital. How do we treat the interest on partners' capital? Interest on partners' capital. Interest to partners are non-allowable. Interest to partners' capital, drawing by partners, salaries to partners, and all payments to partners are basically treated as non-allowable expense. Respond with the yes. Those are treated as non-allowable expense together. So if you look at that income statement or the P&L, the profit and loss, we are basically being told this partnership made a profit of, it made a profit of 1,597,597,000. Tuko pamoja. That this partnership basically made a figure of 1,597,000. So what is that? That is an accounting profit. Are we together? So we call that accounting profit. Are we together? We call that accounting profit. Respond with a yes. We said that accounting profit is normally different from what we call the taxable profit altogether. So we said that for accounting profit, which you've been given, accounting income profit is basically prepared by accountants. And these accountants are basically using accounting principles. Then this is basically shared, reported to the shareholders. However, as a taxman, if you're presented with accounting profit, because accounting is different with taxation. Number one, what is the difference? Number one difference comes on. Number one difference, we say that number one difference basically comes from, we say that in accounting, we have depreciation. In tax, we do not have depreciation altogether. So in this income statement, we can see accountant as depreciation, but we say in tax, we do not have depreciation. Instead of depreciation, we have what we call investment allowance. So this accounting profit that has been provided, a figure of 1,597,000 should be do what? Should be adjusted to get what's called a taxable income. Should be adjusted to get what's called a taxable income. Kindly, Juliet, switch the video. Should be adjusted to get what's called a taxable income. Respond with a yes. So I want us to move to the additional information. So look up. So we're being told that out of advertisement, advertisement expense includes shillings 120. We have advertisement of 380. Advertisement expense includes shillings 120 spent on acquisition of a neon sign. The shillings 120 that is spent on acquisition of neon sign. How do you treat neon sign? The neon signs. So that's a capital expenditure. So that expense for 120 out of 320 out of 380 is non-allowable. So we need to adjust it by adding it back, adding it back. So we proceed to the second additional information. The examiner tells us that general expenses comprise of the following. That if you look at the figures for general expenses, the figure for 50, it comprises of the following. Number one, we have what's called partners and their party. Payments to partners, partners and their party. How do we treat the partners and their party? So that should be non-allowable expense, non-allowable expense. The second, we have what's called staff catering expenses. Staff catering expenses. Staff catering expenses. How would you treat the staff catering expense? The staff catering expense, that should be allowable expense. For the staff catering, that should be allowable expense. And lastly, when you're told a cashier embezzle fund, you cannot tell a taxman that that is an expense. If a cashier embezzle funds, are we to get that is a non-allowable expense, non-allowable expense. So that also needs to be added back, added back. So we proceed to the additional information number 3. The examiner tells us that bad debt represents a general provision. So look at bad debt represents what we call a general provision. So bad debt basically represents what we call a general provision. If it's all that a bad debt basically represents a general provision, in tax we only allow what? A specific provision. Are we together? So when you say general provision, how do you treat general provision? General provision is a non-allowable. So the figure for the bad debt, is it allowable or non-allowable? The figure for the bad debt is non-allowable because it is a general provision. I've said in taxation, we only allow what we call a specific provision for bad debt altogether. But we do not allow a general provision for bad and doubtful debt altogether. What is the difference between the two? I know in accounting or in a fund, when you have an increase in general provision, we call it, it's treated as an expense. Increase in general provision for bad and doubtful debt, we treat it as expense altogether. However, in taxation, an increase in general provision for bad debt is treated as an allowable expense. We only allow what's called specific provision. The essence of this, when you talk about general provision, we say it's always based on estimation. Are we together? To the next, we're being told, so that bad debt is non-allowable. So we go to number 4. So legal fee comprise of the following. Legal fee comprise of the following. So the first legal fee is what we call a parking fine. Parking fines. The first legal fee is what we call a parking fines. So all that is a non-allowable expense. Number 2 is what we call settling dispute with the customer. Legal fee in relation to customers and debtors. How do you treat legal fee? Settling a dispute with the customer. We call it legal fee in relation to customers and debtors. Martin, how do you treat it? Legal fee in relation to customers and debtors. That should be allowable expense. That should be what's called allowable expense. Allowable expense. And lastly, we say appeal on tax assessment. Appeal on the tax assessment. So the last one is basically on appeal on the tax assessment. Appeal on the tax assessment, that should be non-allowable expense. So look at additional information number 5. Additional information number 5. So the examiner tells us that investment allowance were agreed at 380,000 with the Commissioner of Domestic Tax. If you're told that investment allowance was basically agreed at a figure of XYZ by Commissioner of Domestic Tax, what is he telling you? Are we going to calculate? No calculation needed. Are we together? Even if you had investment allowance, we agree that there's no calculation that is basically needed to calculate what we call investment allowance. Are we together? I hope that is at home. Is that information explained perfectly well? Is the information explained perfectly well, even for our newcomers? Those who are joining us today, is the information basically explained perfectly well? Thank you so much. Thank you so much. So then I want to move to the required. We can go to the required. 2022. Which method are we going to use to prepare adjusted taxable profit for the year ended December 2022? Which method are we going to apply in preparing the adjusted taxable income for the year ended? So we're going to use the net profit method. Why net profit method? Why net profit method? Because accounting profit has been provided. Then the second item is basically talking about allocation of taxable profit or loss in C above. So we start with the first one. What is the name of partnership? So we call it Mambo Motor. We call it Mambo Motor, and what's called and motor car partnership. We say adjusted. We call it adjusted taxable, adjusted taxable profit for 2022. So we have the figures here. We have figures there. So we start with accounting profit provided. So we have the accounting profit in P&L, and they say, and what's called taxable income. We say not in P&L, and the taxable income basically not in the P&L. Together, team, we respond with yes. Please explain we've said that the reason why we use the net profit method is because we've been provided the accounting profit. Are you seeing the P&L? That P&L means that we have been provided with the accounting profit. So the reason why we use the net profit method is because we have been provided with accounting profit. Everybody, are we together? Respond to the yes if we're together. If we are together, you give it a yes. Everybody, are we together? Respond to the yes if we're together. If we are together, you give it a yes. Give it a yes if we are together. Perfect. So look up. Also very important that we are in an exam scenario. When you go to exam, I will not require you to write this. Look up, team. These are now the shortcuts. Do you think you're required to write non-allowable? Do you think that somebody is going to mark because you write add back non-allowable expenses in the P&L and taxable income not in the P&L? What is my instruction? At the low-hanging fruits, we say that very importantly, remember, you don't need to write this. Martin, is that noted? You know what is needed. For class purpose, I have to write this because I'm teaching. I have to show you that what are we adding? Non-allowable expenses in the P&L and taxable income not in the P&L. But now for the student, when you get to exam, just write add back. You don't need to write the whole thing. Is that noted? That is there for you to save time. It is there for you to save time. So we start from the P&L, the non-allowable expenses that are in the P&L. So we call the first one is depreciation. We have it as depreciation. What is the figure for the depreciation? So the figure for the depreciation is 148. The figure for the depreciation is 148. So we proceed to the next, we have value added tax. Value added tax. So we have it as the value added tax. What is the figure for the value added tax? The next non-allowable, that should be 1. I hope it is allowable, that should be 1. I hope it is 150. I hope it is 150. Value added tax, that is 150. Then we have the next is still purchase of furniture. We had the purchase of what we call furniture. What is the figure for the purchase of furniture? That should be 620. Purchase of furniture, 620. Then you have goodwill written off. We have the goodwill written off. So for the goodwill written off, that is 225,000. Then you have interest on capital. Interest on capital. Interest on capital. So we have Mambo, and Motor. Is there anybody we are losing or we are together? Favored tuko pamoja? Favored, are we together? Wait first. I'm still on income statement. I'm going to additional information. Don't worry, is when I'm going to the additional information. Is everybody okay up to this point? Perfect, if you're together. So I have an issue with this. Look up, team. Are we together? Look up, team. I have an issue with this, and it normally happens a lot. This one normally happens a lot. This one normally happens a lot. And based on the fact that if you look at this setting, nobody is going to mark a full paper. So it means that everybody is going to mark. Each and every marker is basically going to mark only a single question together. Each marker is only going to mark a single question. So look up, when you're told interest on capital, like we have interest on capital, some students normally love merging it together. Some students will say interest on capital, then you add 140 plus this, that should be 220. Are we there? Some students, Regan, switch off the video. Some students, Regan, switch off the video. Switch off the video. So when it comes to this, look up, team. When it comes to this entry that we call interest on capital, Regan, you switch off the video. When you have the entry on the interest on capital, some students love merging this. And they'll say, for example, 80 plus 140, then it says 220 altogether. The problem with that, and I always advise my students that for this, separate it altogether. Let's say, for example, you have a marker who's rushing. So most of the time, you will not know altogether. You can easily get it wrong altogether. Or you can easily get with a single entry. Marube, switch off the video. Make sure you switch off the video. Regan, switch off the video. So then you make sure that it should be right. But now, depending on whoever is marking that paper, if it's rushing and in an entry, Regan, switch off the video. Kindly switch off the video, Regan. Regan, are you able to hear us? Marube, kindly switch off the video, Regan. Regan, are you able to hear us? Marube, kindly switch off the video. Yes. So then we proceed to the next addition information on general expenses. We have partners and year party. We call it partners. And you say an year party. So for the partners and year party, the figure again is 150. We have it as 150. Then we start catering what's allowable. Then you have what's called embezzlement. Embezzlement by cashier. So what is the figure for the embezzlement by cashier? The figure for the embezzlement by cashier. Embezzlement by cashier. So embezzlement by cashier is basically a figure of 210. Embezzlement by cashier is a figure of 210. I hope you can see those entries perfectly well. So I want us to stretch to this other side of the board. We extend the board. We have this. We can have our line for the board on this other end so that we make it So then we have it on this. We'll continue on this at the end. Are you able to see the board? Are we able to see the board perfectly well? If you're able to see the board perfectly well, we respond with yes. Thank you. So then we go to the next bad debt. You find should be 130. Settling a dispute of a customer was allowable. Appeal. Then we have lastly appeal on tax assessment. We call it appeal on tax assessment. Appeal on the tax assessment, that is to 10. So get for me total non-allowable expenses. Add for me the total non-allowable expenses. Add for me the total non-allowable expenses. So the total non-allowable expenses. The total non-allowable expenses. What is the total non-allowable expenses? If you add them, what is the total non-allowable expenses? What is the total non-allowable expenses? If you add them, what is the total non-allowable expenses? The total non-allowable expenses. So we have it 24. So we have it 24, 33. So that is okay. Can somebody confirm that? Did you say less? We move to less to what we call deduct. So say here less to what we call deduct. Then we'll give you some secrets. Deduct, what we call non-taxable. We call it operating income. Operating incomes. As you say in P&L, non-taxable operating income in the P&L. We have investment income. We have the investment incomes in P&L, investment income in P&L. Then we have allowable expenses. We call it not in P&L. Allowable expenses not in the P&L. Again, for teaching purpose, we're saying that for teaching purpose, we're basically saying that for the teaching purpose, we're saying that we must show what we are lessing. So we're saying that what are we lessing? Non-taxable operating income. For example, what is the examples of non-taxable? Example of the non-taxable operating income. So example of the non-taxable operating income, unrealized foreign exchange gain, unrealized foreign exchange gain. Then you have investment income. For example, dividend income is not a business income. Dividends income is not a business income. Interest income is not a business income. Then lastly, we have what's called allowable expenses not in the P&L. If you're given an income statement by an accountant, outwardly, one of the allowable expenses that you not find in the income statement is what? Is the investment allowance. Then in summary, we're saying for exam purpose, don't write this, you'll be wasting time. In an exam purpose, you just say less to deduct that, and you already know what you need to learn to less. So one of it, we start with sale of delivery van proceed. So we call it sale of what we call of delivery. We call it delivery van proceeds. What is the sale of delivery van proceed? Because that is a non-taxable operating income. What is the figure? The figure is 1.4. The figure is 1.4. The next we have what's called allowable expenses that is not in the P&L, that is the investment allowance. What is the figure for the investment allowance? Investment allowances. What is the figure for the investment allowance? So the figure for the investment allowance, it is provided. So you don't calculate because this is already provided. So the figure is 380,000. So how much do we less? Get the total that we need to less. Get the total that we need to less. So get the total that we need to less. Get the total that we need to less. So what is the total? This should be 17. This should be 1780. So then we have what's called adjusted. We call it adjusted. taxable profit. Adjusted taxable profit. So what is the figure for the adjusted taxable profit? The figure for the adjusted taxable profit. Give me the figure for the adjusted taxable profit. So provide me with the figure for the adjusted taxable profit. So we have 15 plus 2433 and minus 1780. So what are we having? That is 2,250,000. 2,250,000. So tricks, for example. So tricks, we just talk about tricks on exams, on what you've done, tricks on the exam. Look at Chile. So number one, when you're doing this paper, I hope you're there. Number one on this paper, the first trick, the goal is not perfection. Number one, you need to understand the goal is not to be perfect altogether. Is that noted? The goal when you're doing these papers, the goal is to make as many entries as possible. The goal is not for you to be perfect. It's for you to get the right calculation. Because even this marks, it doesn't account for anything in this particular one. In this particular adjusted taxable profit, this will not add to any mark altogether. This particular summation that we've gotten, it does not account for any mark altogether. So as a trick, we are saying that the goal is basically to make as many entries as possible. The goal is not to be perfect, but it's to make up as many entries as possible altogether. So when you're doing this paper, in part one, adjusted taxable income, your concern should not be to add, but your concern should be basically making as many entries as possible. Juliet, are we together? If we're together, we respond to this. Every exam has a way to pass it. Are we together? Some of the students who pass exam is not because the more intelligent than others, but they understand the secret to exam. And that is what you need to know. At this point, what you basically need to know is the secret to exam. How do we get to pass exam? Are we together? You don't need to be perfect. You don't need to even know everything to pass exam. So I've told you that the key things, these are the entries. This. So if you look at this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 14, 15, 15. I have about 15 entries altogether. So if you look at this, this is about 7 marks. If we have 15 entries, logically, the examiner would want only 14 entries altogether. So have you seen me checking on this, on that particular one question? Have I checked on this solution? I have not checked on it, because what is important in the first information on the adjusted taxable income is the entries, not the solution. So let's say, for example, Juliet, I'm in an exam scenario. Let's say, for example, I am in an exam scenario, and I find myself, I have not added this. Should I panic? Juliet, should I panic? If I don't have time, should I panic? You should not panic. I can come here and just decide to guess. As long as I've done the entry and I have no time, I'll just come and guess. I can even guess 1.5. Are we together? I'm saying if you don't have time, don't panic. Don't panic. Are we together? I'm saying don't panic at all. However, because this is partnership, if it was a company, there's if it's a partnership, the only thing that you're going to miss automatically, if this is not right, be assured that you are not able to get the share of profit and loss, share of what you call profit and loss. That is the only thing that you're going to miss on the second part. That is the only thing that you're going to miss on the second part. As you move to the second part, I'm saying very importantly that what you're likely to miss when you're now moving to the second part is what you call the share of profit or loss, share of profit and loss. Because this one now means it has to be correct. The only thing that you're likely to miss is the share of profit or loss. So I want us to go to allocation. Let's move to allocation. Are we there? We respond to the yes signal. If we are there, we respond to this. So I move to the other part. I move to this other part. Once I move to this other part, we call it this part B. We call it allocation schedule. We call it allocation schedule. We call it the allocation schedules. Partnership allocation schedule. We have the partnership allocation schedule. So on the partnership allocation schedule, how many partners do we have for this particular question? How many partners do we have for this particular question? We have 3 partners. So we have Mambo, we have Moto, and then we have what's called Motoka. So then we have what's called total C. So I want students to understand what goes to the partners allocation schedule. That is what you need to know, number 1. So that some things you just put them there. What goes to the partners allocation schedule? Salaries to partners. Are we together? Salaries to partners. We have interest on capital. We have bonuses to partners. Are we together? Or commissions to partners. We have interest on drawing, not drawing, but you have interest on drawing. So we say, what goes to the partnership allocation schedule? That means that you need to understand what's called the format of partnership allocation. Did we provide the format for partnership allocation schedule? Was it provided? Yes, it was provided. So one of the things, again, also very important about exams is understand the formats. What is the format of allocation schedule? What is the format of getting adjusted? So on that format, what do you take to the partners allocation schedule? I've said, number 1 is the partner salaries, interest on capital. We have bonuses to partners, commission to partners. It goes to the allocation schedule. And do we have the salaries to partners on this question? We do not have salaries to partners. Do we have bonuses to partners in this question? Do you have bonuses to partners? We don't have. Do you have commission to partners in this question? We do not have commissions to partners. Do we have interest on drawing in this particular question? We do not have interest on capital. If you have interest on capital, we agree. So if you look at the interest on capital, we pick on the interest on capital. Mambo gets 80. So we have Mambo 80. Moto, we have, Moto is going to be 140. Moto is 140. Do you have motor car? We don't have motor car. So the total here being to 20. A total basically being to 20. So we have a total of 20. We have a total of 20. Together, team. So we do not have any other thing. So we create here what we call share of what we call profit, so what we call loss. All that ultimately. All that share of profit or loss. Then you have the net, we call it the net taxable. That is from the net taxable operating profit. From the adjusted taxable income. What is the net taxable operating income? That should give us 22. We have it 2250. Are we together? 2250. 2252 for 2,250,000. Give me a yes if we are there. So this one we call it B. We give it a call and we call it B. We call it B. We call it B. We call it B. So the next one, we basically, this one we call it A. Are we together? How do you get the profit share, which is in the middle? We call it C. So this C should be B. How do you get the profit share, which is in the middle? We call it C. So this C should be B, which is the net taxable operating income, plus summation of what we have here, summation of A. So what do you have as the profit share? What is the difference? Which is the profit share? B minus A. What are we having? B minus A. What are we having for B minus A? What do you have for B minus A? B minus A, what do you have? B minus A, what do you have? Get from me B minus A, which is the profit or loss share. In this case, that's going to be profit because this is going to be more than summation of A. So that should be, so somebody say 2030, that should be 2030. So this is shared based on ratios, based on ratios. Do you have the ratios? Based on ratios. So this is basically shared based on ratios. This is basically shared based on ratios. So we have the ratios. We had Mambo, Moto, we had Moto, and then we had Motor Car. So we have Mambo, we had Moto, and then we had Motor Car. Mambo, Moto, and then we had Motor Car. So Mambo was basically getting what? Mambo was getting a half times that figure, 2030. Moto and Motor Car were getting a quarter, 2030. Then this also a quarter times 2030. 2030, what do you have? What do you have? So this is 1 million, 15. What about for the two more motor car? So that's 5 or 7, 500. So we get what to call. What is the total? What is the total? 500. If the figures are correct. Are those figures correct? Give me yes if those figures are correct. So perfect. So then we'll say add other taxable investment income. For example, do we have other taxable investment income? For example, farming, rental income, dividends from cooperative society, dividends from cooperative. Do you have other taxable investment income? In this particular question, do we have? We don't have. So for this question, we don't have. If we had, we would have added. So then we say total taxable income. So we don't need to even extend this. This should be okay. So how do we tax partnership? Once we distribute this, how are we going to tax the partners? The way we've distributed the income. How are we going to tax the partners? We say that we're going to tax the partners on what? On a graduated scale. We are going to tax the partner on a graduated scale. Perfect. Are we together? So look up. So this answer, the reason why most students will not get this answer for partnership, this one will be one of the hardest answers to get because this is tied to you being correct on adjusted taxable income. Are we together? Most students will not get this correct because this is tied on you being accurate on the adjusted taxable income. Are we able to note it? So if this question is 2 marks, look at 1, 2, 3, 4, 5. So for this particular question, you only need to get this, put this and this, and you have the whole mark, and you have the whole mark. Is that understood perfectly well? I want to pick a complex question. Yes, it's good to have a complex question. I want us to pick a complex question. Is that understood? We'll respond with a yes if that is understood. If that question is understood, Juliet, to my lawn. Juliet, are we together? Perfect. Is there anybody with a question? Is there anybody with a question? Nani ana swali for the newcomers? Those who are joining us for today, who has a question? I believe none. On December, there's a bit of a complex question, but a very good question. Check December. If you look at December 23, there's something on partnership. There is something on partnership. Yes, Patrick and James and Patrick, Highway Enterprise. So is there anybody who needs a break? Ama tuendelee. Is there anybody who needs a break? Ama tuendelee. Is there anybody who needs a break? Kindly let me know so that I can give you a break. or 29? Yes. How many minutes break? How many minutes break? We don't take a lot of time. So why don't we settle on the middle 7? So it's 7, you should be back 7. We make it 7. Okay. We can pick on the next. So that is December 23, a bit of more complex question. Are you on it? If you're on it, if you are on it, when do we use the gross profit method? When accounting profit is not provided. When are not provided? Give me a yes if we're together. So then we come to this. So being told that James and Patrick, can I start reading? James and Patrick. We are being told that James and Patrick, James, deck 23, question 5D. Deck 23, question 5. We call it question 5D. Question 5D. Question 5D. Question 5D. So if you're there, we get this. So we've been told that James and Patrick, we're told that James and Patrick are partners trading as a highway. So being told that partner trading at as highway enterprise. Are partners basically trading, and you say trading as highway enterprise, and sharing profit and losses equally. So what is the profit and loss sharing? So that basically, Davis, are you there? Davis, are you sorted? Davis, if you're there, you give me a yes. Davis, is everything okay? Davis, is that okay? Okay, perfect. Sharing profit and losses equally. So when you say sharing, are we together? That's basically half. Are we together? 0.5, 0.5. So then you're being told that the following information was extracted is sales a taxable income or a non-taxable income? Sales. Is sales a taxable income or a non-taxable income? So sales should be a taxable income. Then we have the rental income for commercial property. Rental income for commercial property. Is that a taxable income in relation to the business, in relation to partnership? So that's not a business income. Rent is not a business income. Are we together? Rent is not a business income. Betty, that's an investment income. However, it is an investment income that is subjected to further taxation. Betty, are we there? It is an investment income that basically is subjected to further taxation, implying that the rental income for partnership, we are going to take it to allocation schedule. We are going to take it to the allocation schedule. We are going to take it to the allocation schedule. Tafadhali bonyeza yes. Are we together? I hope that is understood. So the next we have what's called dividend income. We have the dividend income, and that is a gross figure. So dividend income is also an investment income. Dividends income is also an investment income. But remember, not only dividends, not all dividends, but you say dividends from cooperative society other than SACCOs. If you receive dividends from a limited company, but if you receive dividends from a limited company, that's a qualifying dividends. So the only dividends that we take to the allocation schedule is dividends that is non-qualifying, and the examples of non-qualifying dividends, that is dividends from cooperative society other than SACCOs. Is that noted? Give me a yes if that is noted. Give me a yes if that is noted. Perfect. So then we have what's called the sundry expenses. Sundry expenses, is that a taxable income or a non-taxable income? Sundry expenses, is that a taxable income or a non-taxable income? Sundry expenses. Sundry expenses. Is that a taxable income or a non-taxable income? No, that's a taxable income. Sundry receipt. Sundry receipt. Sundry receipt is a taxable income. Are we together? That's a taxable income. Sundry receipt is a taxable income. We give it a yes. Sundry receipt is a taxable income. Give me a yes if you're together. If that is at home, you give me a yes. So then we proceed to the next. We'll proceed. So what does it mean when the examiner says gain on foreign exchange realized? Is it taxable or non-taxable? Gain on foreign exchange, and the word is realized. So what does it mean? Is it a taxable income or a non-taxable income? Gains on foreign exchange, realized. Juliet, what is that? That should be taxable. When they say unrealized, how do you choose it? Unrealized. Unrealized, that should be non-taxable. Unrealized is non-taxable, yes, or not taxable. Then interest on deposit with foreign bank. Interest on deposit with foreign bank. Interest on deposit from foreign bank. So interest from outside the country. How do you treat interest from outside the country? Those are tax exempt. In fact, we call them tax exempt. Interest from outside the country, we call those are tax exempt. So when you receive interest from outside the country, we call them tax exempt. So those ones, we are supposed that should be non-taxable. So then we have the next, we call it profit on disposal of machinery. Profit on disposal of machinery, that is profit from a capital expenditure. So that's a non-taxable income. That is a non-taxable income. So then we have what we call less expenses. We move to the expenses. So number one expense, we have cost of goods sold. Cost of goods sold as an expense. Cost of the goods sold. How do we treat the cost of the goods sold? Cost of goods sold. Cost of the goods sold. Cost of what we call goods sold. So that's allowable. That should be allowable. Then we have registration of patent. Registration of patent. How do you treat? So that's allowable. That should be allowable. Then we have registration of patent. Registration of patent. How do you treat the registration of patent? Registration of patent. Registration of patent. Registration of patent. What did you say? That should be non-allowable. Registration of patent, that should be non-allowable. So registration of patent is non-allowable. Then you say hosting a business website. Hosting a business website. Hosting a business website. That's a non-allowable expense. Non-allowable expense. Hosting a business website, that should be a non-allowable expense. Hosting a business website is a non-allowable expense. The next, we have what's called purchase of a computer. How do we treat purchase of a computer? That should also be non-allowable expense. Then you have what's called staff salaries and wages. Staff salaries and wages. Staff salaries and wages. The word is staff, so that should be allowable expense. So then we go to the next, partner salaries. We have James and Patrick. So the partner salaries, those are outrightly non-allowable expense. That is for the partner salaries. Then we have what's called audit fee. Audit fee. Audit fee, that should be allowable expense. Then you have insurance. Insurance. Insurance, that should be allowable. Purchase of office machinery. Purchase of what is called office machinery. So how do we treat the purchase of office machinery? Purchase of office machinery, that's a capital expenditure. We claim investment allowance on that. Then you have commission to partners. Commissions to partners, payments to partner. How do you treat them? Commissions to partners. Commissions to partners. Then you have commission to partners. Commissions to partners, payments to partner. How do you treat them? Commissions to partners. Commissions to partners. Commissions to partners, that should be non-allowable. So then you have the next stamp duty, impairment of goodwill, that is also non-allowable. Then we have the next, bank charges. Those are interest rates. Bank charges, how do we treat the bank charges? How do we treat the bank charges? Bank charges, interest rates, how do we treat the bank charges? No. Bank charges is different from loan. Bank charges are interest rate. So bank charges are allowable. Fixing of neon sign. Fixing of neon sign. Fixing of neon sign. So that's not allowable because neon sign is a capital expense. Are we together? Fixing of neon sign, that should be non-allowable expense. Fixing of neon sign, that should basically be non-allowable expense. So we have the next, we have what we call VAT paid. All forms of taxes, VAT paid. VAT paid is what? Is non-allowable expense. VAT paid is a non-allowable expense. Then you have the next, what we call gift to employees. Before that, we have legal fees. How do you treat the legal fees? Legal fees. Legal fees. If there's no additional information, is allowable. However, we check the additional information. It's important that we check additional information. Then you have gift to employee, gift to employees, gift to employees, gift to employees. So we had repairs of machinery, repairs of machinery. That should be on the repairs of machinery. Repairs of machinery, no. Repairs of machinery is different from machinery, purchase of machinery. So repairs of machinery, Betty, that should be allowable expense. There's a difference. Repair of machinery is a revenue expense, which is allowable, but purchase of a machinery is a capital expenditure. So that is a capital expenditure. Favored, are you there? Favored and the rest of the team, are you there? If we are there, we give it is. Ibrahim, are we there? Thanks, Regan. Are we together? Regan, I hope you're there. So then we have we have the next item. We call it purchase of a telephone equipment. Purchase of a telephone equipment. So that's a capital expenditure, that's non-allowable. Then you have gifts to employees. We have the gifts to employees, what we call the gifts to employees for meeting the targets. Will you allow that? For meeting the targets. When they meet the target, gifts to employees for meeting the targets. For meeting the targets. Why do you say not allowable? Is it not related to what? Because these guys are basically achieving the target. So that should not be treated as non-allowable. That should be allowable. Are we together? Are we together? So then we have the next, we call it, we have what's called, we have the next, donation to Red Cross. We say donation to Red Cross. So they've not just said donation to a local church, they've said donation to Red Cross. When they say donation to Red Cross, is that allowable or non-allowable? Donation to Red Cross. It's a charity. When they say Red Cross, then that should be allowable. Are we together? Are we together? So then we have the next, the cost of, loans to employees written off. Loans to employees written off. Is that an allowable expense? Really? Loans to employees written off. Loans to employees written off. Can you tell the taxman that loans to employees written off is an allowable expense? Is that allowable expense or non-allowable expense? Loans to employees written off. That should be non-allowable expense. That should be non-relocation. So cost of relocation to a new premise. Premise is a capital expenditure. In fact, when we talk about premise, These are more capital in nature. When you talk about relocation, these are more capital in nature. When you talk about relocation, we have, when you talk about relocation, we have a lot of it is on capital expenditure. We check it out. Look up when you are relocating. We have Musa and the rest of the team. When you are relocating, a lot of expense is basically incurred on a more capital in nature. Are we in agreement? Look at him. Are we in agreement when you are relocating? Yes. So that's why in most of the cases, however, if they're very specific, that this was transport from X to Y, then that we can pick out as allowable expense. Are we together? Regan Marube, that one can easily pick as allowable expense. However, when they say that I'm saying somebody has a very good question here. Betty, forward that question again. Maleo, please explain, are we relocating to our own building? We are saying, Betty, give me a yes, Betty. Most of the time when you talk about relocation, most of the time when you talk about relocation, Betty, most of the expenses are basically capital in nature because you're buying assets altogether. You are we will always treat it as an allowable expense. Non-allowable expense. Betty, I hope I've answered you. Respond with a yes if you're together. Respond with a yes if you're together. Yes, if there's no additional information, then that would be non-allowable. That would be outrightly non-allowable. So, thank you so much. Are we together? Then we have the next. We have what's called redundancy payment to employees. Redundancy payment to employees. How would you treat redundancy payment? Redundancy payment to employees. Redundancy payment to employees. You're laying off, that can be treated as allowable. Then you have investment seminar for the retired. Investment seminar for the retired. Investment seminar for the retired. How would you go about investment seminar for the retired? For the retired, how would you go about it? Investment. Why do you say non-allowable? If they're in the process of retired, that would be allowable together. We'll go avoided. When you're laying off people, are we together? No, it means that retirement is a process altogether. Retirement is a process altogether. Are we together? It doesn't mean that they are fully retired together. So those who are retiring, you can have an investment seminar for them, maybe just to educate them. Are we together? I'm saying, you see, when you say retired, it doesn't just physically mean, it doesn't just mean that investment seminar for the retired employees. It's a process altogether. Sometimes, for example, when you're retiring employees, are we together? You also train them on how they'll basically do what? They'll basically survive outside there. Are we together, everybody? So for those employees who are retired and you're basically incurring cost to basically train them on how maybe to survive, that would be treated as allowable expense. Are we together? That would be treated as allowable expense. Together, everybody. Give me a yes if you're together. So then we have the last one, we call it depreciation. We call it depreciation. Is depreciation allowable or non-allowable expense? So that's outwardly non-allowable. So if you look at accounting profit, this business is basically making a profit of 11,745,000. So which method are we going to apply if we're told to get adjusted taxable income? Adjusted taxable income. So we're going to use that. So I want us to go to the additional information. Though our time is running, we can try and finish this together. So insurance, look at insurance. So we're told that insurance cover for imported machinery, insurance cover for the imported machinery against loss on transit. Against loss on transit. Against loss on transit. Then we have insurance cover for the business premise. So insurance cover for imported machinery. Is that an allowable expense? 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 Insurance cover for an imported machinery. We've done capital investment. So when you have insurance cover for an imported machinery, investment allowance, that is going to be added to, is going to, how would you treat the insurance cover for the premise? That should be allowable. Then we have next, legal fee. So being told legal fee included 25,000 incurred on drafting a loan agreement between partnership and the bank. Legal costs incurred to draft a loan agreement. What did he say? Legal costs incurred to draft a loan agreement. How do you treat it? Non-allowable expense. That should be non-allowable expense. Are we in agreement? That should be non-allowable expense. So then we have the cost of carriage, the cost of carriage of machine, the cost of carriage of what we call, the cost of carriage of machine to the premise, the cost of carriage of machine to the premise amounted to 34. So machine to the premise amounted to 34. So carriage of machine to the premise